Good noon to everyone. This is Dr. D. Kattika, Department of Commerce with Computer Applications, Dr. Snsinstitutions, College of Arts and Science. Today in our corporate tax series, we are going to discuss about the tax on distribution of your profits. Already we have discussed about the taxable liability, taxable income, residential status of a company, what is a company, assessment of companies, and also we have discussed enough about the tax income and liabilities clearly. So today we are going to discuss about the tax on distribution of your profits. If you have any doubts in your taxable income and liabilities, kindly go to my previous videos and kindly have a check about it and come back and listen to this tax on distribution of your profits. So tax on distribution of profits involves various rules and implications depending on the type of the entity, the nature of the distribution and the jurisdiction in the question. So here's an overview focusing on primarily on the tax implications in India. First one, the tax on distribution of profits in India. Dividend Distribution Tax. So we have to understand the historical concept so that we will have a clear picture on the distribution of the profits in India. So first we have to understand about the Dividend Distribution Tax, that is the DDT in short. In the past, companies are required to pay the Dividend Distribution Tax, or that is on the dividends distributed to the shareholders. As we all know, the dividends is nothing but the reward given to the shareholders for their investment. It has to be paid regularly. So when we are paying a amount regularly, automatically we have to pay the tax. So similarly, we are going to pay the tax for the dividends for the distributed to the shareholders. So this tax was levied at a specified rate on the gross amount of the dividends declared, and the company was responsible for paying this tax before distributing dividends to the shareholders. So the rate of DDT, the rate was typically 15% plus a 12% surcharge and 4% for the health and education cess. 4% for the health and education cess, making the effective rate around 20.56%. And next one is your current regime, that is post financial year 2021 we are giving. Revised taxation DDT was abolishing these starting from the financial year 2021. Instead of the tax burden on dividends was shifted to the shareholders. Dividend taxation in the hands of the shareholders. It is shifted to the shareholders. How? For the individuals, dividends received by the individuals are taxable under the head income from other source at applicable income tax rates based on their income slab. But for the companies, dividends received by the companies are taxable as income. However, such dividends may be subject to a lower tax rate if received from other Indian company under the exempt income category as per the provisions of section 1034 of the Income Tax Act. And for the foreign shareholders, dividend paid to the non-resident shareholders are subject to the tax in India at the applicable rates, which may be reduced under the double taxation avoidance agreements. So that is already discussed, that is DTAs. So we are able to understand from the financial year 2021 the shift has been given to the shareholders, so the tax will be paid by the shareholders for the dividend. Tax liability, it is the amount already we have discussed enough about this tax liability. Still I have given you a review of what is tax liability here. The tax liability is the one where the company is required to pay based on their taxable incomes. So the taxable income by subtracting the deductions and exemptions from the gross income, we are able to understand what is your taxable income. And calculation of the taxable liability for a individual as well as the company, it differs. For the company, it is fixed percentage, and how to calculate for the tax liability you have understood. It is the income minus the business expenses and the deductions. And TDS on dividends. So let us understand what is TDS. That is tax deducted at source, which are required to deduct the tax deducted at source on the dividends paid to the shareholders. The TDS rate is typically 10% for resident shareholders and may vary for non-residents based on the applicable treaties and the provisions. So what is the rate of the TDS? The rate of the TDS on the dividends, it is 10% and subject to the certain conditions. That is, for non-resident, the TDS rates can vary based on the provisions of the Income Tax Act or applicable DTAs. And tax on other forms of the profit distribution, bonus shares, the issue of the bonus shares, that is additional shares given to the existing shareholders for free, that is known as your bonus shares, does not attract the immediate tax. However, the cost of acquiring the bonus shares is considered zero, which may affect the capital gain tax calculating when the shares are eventually sold. And then buyback of shares, that is, when a company buys back its shares from its shareholders, it is subject to the tax. The company must pay the buyback tax, which is generally levied at 20% plus applicable surcharge and the cess. The buyback tax are not taxable in hands of the shareholders. That has to be noted. Then tax on buyback, according to the section 115QA of the Income Tax Act, the company's buyback share are required to pay a tax on the distributed amount, effectively treating the buyback amount as a distribution of the profits. And then tax implication for different entities, that is your companies, partnership firms and LLPs, trust and estates, it differs. For the companies, it has to pay the tax on profits before distributing dividend or engaging the buybacks. After the abolition of the DTT, companies must ensure TDS is correctly deducted on dividends paid to the shareholders, or it will be the burden to the companies to pay the tax. Then partnership firm and LLPs, that is limited liability partnership, typically do not pay the tax on profit distributed to the partners or members. Instead, the individual partners or the members pay the tax on their shares of the profit as a part of their personal income. Then trust and estates, they distribute the income to beneficiaries, and such distribution may be subject to specific rules under the tax laws. Then practical consideration for your tax planning, companies should plan profit distribution strategies in consultation with the tax professionals to optimize tax liabilities and ensure compliance with applicable tax laws. And then proper compliance with the TDS obligations, accurate reporting of dividends and adherence to tax laws are crucial to avoid the penalties and ensure the smooth operations. So in conclusion, the tax on distribution of profits involves several components, including tax on dividend, buyback of shares and related tax implications for different types of entities in India. The abolition of DTT has shifted the tax burden to the shareholders, and the companies are now required to deduct TDS on the dividends. So understanding these rules helps in effective tax planning and compliance. Okay, thank you so much for listening to my YouTube, and kindly ping me if you have any doubts in this videos. Thank you so much.